What you're about to hear is going to sound impossible, but I need you to stay with me, because what's happening in the gold market right now is something most people won't understand until it's too late. And by then, the opportunity will be gone. There's a window closing, not in months, not in weeks. We're talking about a matter of days before something fundamental shifts in the precious metals market that could lock out everyday investors from accessing gold at these levels ever again. And I'm not being dramatic. The data I'm about to show you tells a story that Wall Street doesn't want you to see. Let me start with something that happened that barely made the news. Central banks around the world have been accumulating gold at a pace we haven't seen in modern history. But here's what's interesting. They're not just buying. They're accelerating their purchases right now at this very moment, even as gold sits near all-time highs. Think about that for a second. These are the most sophisticated financial institutions on the planet. They have access to information and analysis that you and I will never see, and they're buying gold aggressively at these elevated levels. Why would they do that? What do they know that the average investor doesn't? The answer is going to surprise you. Because it's not just about inflation. It's not just about geopolitical tensions. It's about something much bigger, something that's been building for decades and is now reaching a critical inflection point. Before we go deeper, I want to make sure you have access to the research that backs up everything I'm about to share. I've put together a free guide that shows the saving secrets thousands of American retirees are using to protect their hard-earned wealth. It's in the description below. Grab it now so you have it for reference as we go through this analysis. Now let me take you back to a moment in history that most people have forgotten. It was the summer of 1971. President Nixon stood before television cameras and announced that the United States would no longer convert dollars to gold at a fixed rate. In that single moment, he severed the last link between the dollar and gold. The Bretton Woods system collapsed, and the world entered an era of pure fiat currency. What happened next? Gold went from $35 an ounce to over $800 within a decade. That's not a 20% gain. That's not even a 100% gain. That's a 2,000% increase. And it happened because the fundamental nature of money changed overnight. Here's why I'm bringing this up. We're living through another fundamental shift right now, and most people don't see it because it's happening in slow motion. But the central banks see it, the sovereign wealth funds see it, the billionaires see it, and they're positioning themselves accordingly. Let me show you what's actually happening beneath the surface. Gold has been trading in a range that, on the surface, looks relatively stable. But when you dig into the data, you see something extraordinary. The physical gold market and the paper gold market are diverging in ways we've never seen before. Here's what I mean. On the COMEX, the futures exchange where most gold trading happens, you have massive amounts of paper contracts representing gold. These are essentially IOUs, promises to deliver gold at some point in the future. For decades, this system worked because most of those contracts never actually demanded physical delivery. Traders would just roll their positions forward or settle in cash. But something changed. The percentage of contracts standing for delivery, meaning people actually demanding the physical metal, has been climbing steadily. And it's not just retail investors, it's institutions. It's foreign central banks. It's sovereign wealth funds. They're saying, we don't want your paper promises anymore. We want the actual metal. Now here's where it gets interesting. The COMEX has a certain amount of physical gold in its registered vaults. That's the gold that's actually available for delivery against these contracts. And when you look at the ratio of open interest, the total number of contracts outstanding, to the actual physical gold available, you start to see a problem. We're approaching levels where, if even a small percentage of contract holders demanded physical delivery, the system wouldn't be able to fulfill those demands, not without draining the vaults completely. And once those vaults start to empty, what do you think happens to the price? This is exactly what happened in the silver market back in the early 2000s. The Hunt brothers tried to corner the silver market by taking physical delivery. The exchange had to change the rules mid-game to prevent a complete meltdown. But this time, it's not a couple of billionaires trying to manipulate the market. It's central banks. It's entire countries. You can't just change the rules on sovereign nations. Let me give you a specific example. The People's Bank of China has been steadily increasing its gold reserves. But here's what's fascinating. The official numbers they report are almost certainly understated. Why? Because China has a strategic interest in accumulating gold quietly, without driving up the price before they've acquired the amount they want. Independent analysts who track gold flows through Hong Kong, Shanghai, and other channels estimate that China's actual gold holdings could be several times higher than what they officially report. And they're not alone. Russia, India, Turkey, Poland. Central banks across the world have been net buyers of gold for over a decade now. But the pace has accelerated dramatically in recent months. And this is happening while Western central banks, particularly the Federal Reserve and the European Central Bank, are sitting on massive gold reserves that they accumulated decades ago. They're not selling. They're holding. Because they understand what's coming. Now, let's talk about what's driving this. And this is where most mainstream analysis gets it wrong. They'll tell you it's about inflation. They'll tell you it's about uncertainty. And sure, those factors play a role. But the real story is about the dollar's role as the global reserve currency. For the past 80 years, the dollar has been the foundation of the global financial system. Countries around the world hold dollars as reserves. International trade is conducted in dollars. Commodities are priced in dollars. This gives the United States an enormous advantage. We can print dollars, and the rest of the world has to accept them because they need dollars to participate in the global economy. But that system is breaking down, and it's not happening because of some conspiracy. It's happening because of basic economics and geopolitics. When you weaponize the dollar, when you use it as a tool of foreign policy, when you freeze countries out of the SWIFT system, when you impose sanctions that prevent nations from accessing their dollar reserves, you create an incentive for those countries to find alternatives. And that's exactly what's happening. The BRICS nations, Brazil, Russia, India, China, South Africa, have been working on alternative payment systems. They're conducting bilateral trade in their own currencies. They're building infrastructure that bypasses the dollar entirely. And at the center of this shift is gold. Gold is the one asset that every central bank recognizes. It has no counterparty risk. It can't be frozen or sanctioned. It's been money for 5,000 years. And as trust in the dollar-based system erodes, gold becomes increasingly important as a neutral reserve asset. Now here's where the 3-day timeline comes in, and this is critical. There are several factors converging right now that create a very narrow window of opportunity. First, we're seeing technical breakouts in the gold market that suggest a major move is imminent. Gold has been consolidating in a pattern that technical analysts call a bull flag. This is a continuation pattern that typically precedes a significant upward move. The longer the consolidation, the more powerful the eventual breakout, and we've been consolidating for months. Second, there are major geopolitical events unfolding that could serve as catalysts. Without getting into specific dates or events, because those can change, what matters is the underlying tension. The Middle East remains a powder keg. Relations between major powers are deteriorating. The risk of a significant geopolitical shock is higher than it's been in decades. Third, and this is the one most people miss, there are structural changes happening in the gold market itself. New regulations, new trading mechanisms, new ways for institutional investors to gain exposure to physical gold. These changes are making it easier for large pools of capital to flow into the gold market. And when that capital starts moving, it moves fast. Think about what happened when gold ETFs were first introduced. Suddenly, investors who couldn't or wouldn't buy physical gold had an easy way to gain exposure. Billions of dollars flowed into these products. The price of gold more than doubled in the years that followed. We're on the cusp of something similar, but potentially much larger. Now, I want to address something that's probably on your mind. You're thinking, I've heard this before. People have been predicting a gold explosion for years. Why is this time different? Fair question. And you're right to be skeptical. But here's the difference. In the past, the bull case for gold was largely theoretical. It was based on what might happen, what could happen. Today, it's based on what is happening. The data is undeniable. Central bank buying is at record levels. That's not a prediction. That's a fact. The physical gold market is tightening. That's not a theory. That's measurable. The dollar's share of global reserves is declining. That's not speculation. That's in the official data. And here's something else. The mining supply of gold is constrained. It takes years to bring a new gold mine online. Exploration has been underfunded for over a decade. The easy gold has already been found. Production is flat to declining. Meanwhile, demand is surging. That's a recipe for a supply squeeze. Let me tell you a story that illustrates what happens when supply and demand get out of balance in the gold market. Back in 1979, gold was trading around $200 an ounce. Inflation was high. Geopolitical tensions were elevated. The Soviet Union had just invaded Afghanistan. The Iranian Revolution had just toppled the Shah. Investors started buying gold, not just in the United States, but around the world. And as the price started to rise, it created a feedback loop. Higher prices attracted more buyers. More buyers pushed prices higher. Within a year, gold had quadrupled to over $800 an ounce. But here's what's important. The people who made life-changing wealth from that move weren't the ones who bought at the top. They were the ones who positioned themselves early, when gold was still in the $200 to $300 range, when everyone else was still skeptical, when the mainstream media was still dismissing gold as a barbarous relic. We're in a similar moment right now. Gold is near all-time highs, yes. But when you look at gold relative to the money supply, relative to global debt, relative to the size of the financial system, it's actually historically cheap. Gold hasn't kept pace with the expansion of fiat currency, and at some point, that gap has to close. Now, let's talk about what this means for you personally, especially if you're in or approaching retirement. Because this isn't just about making money, it's about protecting what you've already built. Think about your retirement savings. If you're like most Americans, the bulk of your wealth is in stocks and bonds, maybe some real estate, and for decades that's been a solid strategy. But we're entering a period where the traditional 60-40 portfolio might not provide the protection it once did. Why? Because stocks and bonds are both vulnerable to the same forces: rising inflation, currency devaluation, geopolitical instability. When those forces intensify, both stocks and bonds can decline simultaneously. We saw this happen in the 1970s. We saw it again in 2008. And we're seeing early signs of it now. Gold, on the other hand, tends to move inversely to these forces. When confidence in the financial system declines, gold rises. When inflation accelerates, gold rises. When geopolitical tensions spike, gold rises. It's not perfect. Nothing is. But it provides a form of insurance that you can't get from traditional financial assets. And here's something most financial advisors won't tell you. You can hold gold inside your retirement account. It's called a gold IRA, and it allows you to get physical gold, actual bars and coins, into your tax-advantaged retirement account without triggering any tax penalties. I put together a comprehensive guide on how this works. It's in the description below. If you're sitting on $100,000 or more in retirement accounts, this is worth looking at. The guide covers how to set up a gold IRA, what types of gold qualify, how the storage works, all of it. And if you're serious about protecting your retirement, there's also information about getting a one-on-one educational consultation. No obligation, just education. But you need to have at least $100,000 in retirement accounts to qualify. Anyway, back to what's happening in the market. Because there's another layer to this that we need to discuss. And it has to do with the relationship between gold and silver. Silver is often called gold's little brother. And for good reason. It tends to follow gold's moves, but with much more volatility. When gold goes up 10%, silver might go up 20 or 30%. When gold goes down 10%, silver might go down 20 or 30%. It's a leveraged play on the same fundamental forces that drive gold. But silver has something gold doesn't: industrial demand. Silver is used in solar panels, electronics, medical devices, electric vehicles. The green energy transition that governments around the world are pushing requires massive amounts of silver. And unlike gold, where most of the demand is for investment in jewelry, silver gets consumed. It gets used up in industrial applications and isn't economically recoverable. This creates a unique situation. Investment demand for silver is surging as people look for alternatives to the dollar. Industrial demand for silver is surging as the world transitions to new technologies, and supply is constrained because most silver is produced as a byproduct of other mining operations. You can't just decide to produce more silver the way you might with other commodities. The result? Silver is setting up for what could be an even more explosive move than gold. And historically, when gold makes a major move, silver follows with even greater percentage gains. In the 1970s, gold went up 20-fold. Silver went up 40-fold. In the 2000 to 2011 bull market, gold went up 6-fold. Silver went up 12-fold. If we're entering another major bull market in precious metals, and all the evidence suggests we are, silver could potentially outperform gold by a significant margin, but it's also more volatile, more risky, so you have to size your position appropriately. Now let's talk about the mechanics of what happens when a market like this really starts to move. Because it's not a smooth, steady climb. It happens in waves. And understanding these waves is crucial to navigating the market successfully. The first wave is driven by the smart money. The central banks, the sovereign wealth funds, the billionaires who have access to the best information and analysis. They start accumulating quietly. They don't want to drive up the price before they've built their positions. This phase can last for years, and we've been in this phase. The second wave is driven by institutional investors, hedge funds, pension funds, endowments. They start to notice what the smart money is doing. They see the fundamentals improving. They begin to allocate capital. This is where the price starts to move more noticeably. We're entering this phase now. The third wave is driven by retail investors, regular people who see the price moving and don't want to miss out. This is where the real acceleration happens. This is where you get the parabolic moves, the 10% days, the 20% weeks. This is also where most people get in, right before the top. We're not there yet, but we will be. The key is to position yourself in the second wave before the third wave arrives, because once the retail frenzy starts, the opportunity to buy at reasonable prices is gone. You're competing with millions of other investors all trying to get in at the same time. And that's when you get the blow-off top, the unsustainable spike that eventually crashes back down. But here's the thing. Even after the crash, the price typically settles at a level much higher than where it started. Gold went from $35 to $850 in the 1970s, then crashed back to $300. But $300 was still 10 times higher than where it started. Gold went from $250 to $1,900 in the 2000s, then corrected to $1,200. But $1,200 was still 5 times higher than where it started. So even if you don't time it perfectly, even if you buy before the peak and hold through the correction, you're still likely to be significantly ahead if you position yourself early enough in the cycle. Now, I want to address the elephant in the room, the risk. Because there's always risk, and anyone who tells you otherwise is lying. The biggest risk to the gold bull case is if the Federal Reserve and other central banks somehow manage to restore confidence in fiat currencies. If they can bring inflation under control without crashing the economy, if they can maintain the dollar's dominance without resorting to increasingly aggressive monetary policy, if they can navigate the geopolitical tensions without a major crisis. Is that possible? Sure. Anything's possible. But look at the track record. Look at the debt levels. Look at the political constraints. Look at the structural problems in the global economy. And ask yourself, honestly, do you think they can pull this off? I'm not saying they can't. I'm saying the odds aren't in their favor. And when you're making decisions about your financial future, you have to play the odds. You have to position yourself for the most likely outcomes, not the outcomes you hope for. Another risk is government intervention. History shows that when gold starts to threaten the established monetary system, governments sometimes take drastic action. In 1933, the U.S. government literally confiscated gold from private citizens. They made it illegal to own gold. They forced people to sell their gold to the government at a fixed price. Then they immediately revalued gold higher, effectively transferring wealth from citizens to the government. Could that happen again? It's unlikely. The political and economic context is completely different. But it's not impossible, and it's something to be aware of. This is one reason why diversification is important. Don't put all your eggs in one basket. Don't bet everything on gold, but don't ignore it either. Let me share another historical parallel that's relevant here. In the late 1990s, gold was in a bear market. It had been declining for nearly 2 decades. Most investors had written it off. The conventional wisdom was that gold was a relic, that in the modern financial system there was no need for gold. Central banks were selling their gold reserves. The Bank of England famously sold half of Britain's gold reserves at the absolute bottom of the market, around $250 an ounce. It became known as Brown's Bottom, named after Gordon Brown, the Chancellor of the Exchequer who orchestrated the sale. But a few contrarian investors saw something different. They saw that gold was historically cheap. They saw that the fundamentals were improving. They saw that the bear market was creating an opportunity, and they started accumulating. One of those investors was John Paulson. You might know him as the guy who made billions betting against subprime mortgages in 2008. But before that, he made a fortune in gold. He started buying gold and gold mining stocks in the early 2000s when everyone else thought he was crazy. By 2011, his gold fund had returned over 700%. The point is, the best opportunities often come when the consensus is against you, when everyone else is skeptical, when the mainstream narrative says you're wrong. That's when the risk-reward is most favorable. And right now, despite gold being near all-time highs, the mainstream narrative is still skeptical. Most financial advisors still recommend little to no gold allocation. Most investors still have zero exposure to precious metals. The general public still thinks of gold as something your grandfather bought, not as a serious investment. That's going to change. And when it does, when the narrative shifts, when gold becomes the consensus trade, that's when you'll wish you had positioned yourself earlier. Now, let's talk about the practical steps you can take, because understanding the opportunity is one thing, acting on it is another. First, determine how much of your portfolio should be in gold. This depends on your individual circumstances, your age, your risk tolerance, your other investments. But as a general guideline, many experts recommend anywhere from 5 to 20% of your portfolio in precious metals. Some aggressive investors go higher. Some conservative investors go lower. There's no one-size-fits-all answer. Second, decide how you want to hold gold. Physical gold, gold ETFs, gold mining stocks, gold futures. Each has advantages and disadvantages. Physical gold gives you direct ownership, but you have to worry about storage and security. ETFs are convenient, but you don't actually own the metal. Mining stocks give you leverage to the gold price, but they come with company-specific risks. Futures are for sophisticated traders only. For most people, a combination makes sense. Some physical gold for security, some ETFs for liquidity, maybe some mining stocks for upside potential. And if you're holding gold in a retirement account, a gold IRA gives you the benefits of physical ownership with the tax advantages of a retirement account. Third, think about timing. And this is where the 3-day window comes in. I'm not saying the world is going to end in 3 days. I'm not saying gold is going to double in 3 days. What I'm saying is that we're at a critical juncture. The technical setup is there. The fundamental drivers are there. The catalysts are there. And when all of these factors align, things can move very quickly. You don't want to be the person who spends months researching and analyzing and waiting for the perfect entry point, only to watch the market run away from you. Sometimes the cost of waiting is higher than the cost of being slightly early. Let me give you one more piece of historical context. In 2008, during the financial crisis, gold initially sold off along with everything else. People needed cash. They were liquidating whatever they could. Gold dropped from around $1,000 to $700 in a matter of weeks. But then, something interesting happened. As the full extent of the crisis became clear, as governments started printing money on an unprecedented scale, as the Federal Reserve dropped interest rates to zero and launched quantitative easing, gold reversed course. It went from $700 to $1,900 over the next 3 years. That's a 170% gain. The people who panicked and sold at $700 missed one of the greatest bull markets in gold's history. The people who understood the bigger picture, who saw past the short-term volatility, who recognized that the policy response to the crisis would be massively inflationary, Those people made fortunes. We're in a similar moment now. The policy responses to recent economic challenges have been even more extreme than in 2008. The money printing has been even more aggressive. The debt levels are even higher. The structural problems are even more severe. And yet, gold is only moderately higher than it was at the peak in 2011. That tells you something. It tells you that gold hasn't fully priced in the implications of what's happened over the past 15 years. It tells you that there's significant upside potential. It tells you that we're still early in this cycle. Now, I want to be clear about something. I'm not a fortune teller. I can't predict the future with certainty. Nobody can. What I can do is analyze the data, study the history, understand the fundamentals, and make informed judgments about probabilities. And based on everything I'm seeing, the probability of a major move higher in gold over the next few years is very high. Not certain, but high. High enough that it makes sense to position yourself accordingly. High enough that the risk of not having exposure to gold is greater than the risk of having exposure. Think about it this way. If gold goes up 50% and you have no exposure, you've missed an opportunity. If gold goes down 20% and you have a reasonable allocation, you've lost a small percentage of your portfolio. But if gold goes up 300%, which is entirely possible based on historical precedent, and you have no exposure, you've missed a life-changing opportunity. The asymmetry of the risk-reward is heavily skewed to the upside. The potential gains far outweigh the potential losses, and that's the kind of setup you want to be in.